The Rebel Capitalist Show.
Rick, one thing that I kind of struggle with personally is I just try to keep it as simple as possible for my own portfolio. And that's one of the reasons why I like commodities, because outside of the producers, it's pretty easy to tell when the commodity is quote unquote cheap or expensive, historically speaking. You just didn't adjust for inflation. And oil is the example I use there. I've pulled up a chart of oil going back, I don't know, as far as I can, 100 years or so. And if you adjust for inflation, you see that when it gets under 30 a barrel, it seems to be pretty cheap because it kind of reverts to a mean. And then when it gets over maybe 80, 85, it starts to get expensive. So, back in March of 2020, oil was maybe, I don't know, 20 bucks or something. And I thought it was going down further, but I wanted to buy, and I did buy a lot of the producers, not because I thought the price was going higher, but at the time it was cheap. And so now we're kind of on the flip side of that coin where oil is at $90 a barrel. And I've tried to kind of scale out of my position just by selling calls. I'm not that sophisticated, but I've got my research assistant helps me out with that. A 19-year-old kid that's far more sophisticated than I am. And but that we haven't hit the strike price or so on. But my point is, I believe that oil prices will most likely go much higher in the future. But if I look at my own rules that I've set up for my portfolio, it's expensive, therefore I should consider selling. How do you think through that process?
Wonderful question. And the answer is in the middle somehow. First of all, your methodology, simple is always better. And if you're patient, you can afford to be simple. It's those people who care about a move between now and the next long weekend that have to be complex. For people who have a 5 or 6 year time frame, life can be simple. I use a metric that's very similar to yours. I look at what the International Energy Agency says is the total cost of producing a barrel of oil. That's not just the lifting cost, but rather it includes the exploration costs, G&A, prior year write-downs, which can be huge in the exploration business, social rents, and cost of capital. And the International Energy Agency suggests that worldwide, the fully loaded cost to produce a barrel of oil is between 55 and 60 US dollars. Okay. So when the price of oil is substantially below that, the industry is in liquidation. It's a capital intensive business. There's rapid decline rates. And to the extent that you aren't making sustaining capital and new project investments, you are within a 2 or 3 year time frame, greatly crimping supplies. Similarly, when the price goes up to a substantial premium to that, people do in fact begin to conserve. Markets work, and companies are able and willing to make sustaining capital investments. We're in the odd position now where the oil price is superb from a producer's point of view, but they haven't picked up the pace of capital investments, sustaining capital investments, or new project investments. I'm not sure. I think that might be because of Trudeau and Biden and Merkel. I think it might be because the big thinkers of the world are so busy unveiling against energy that investors in energy are asking the companies to return capital to owners as opposed to making sustaining capital investments. If that's the case, higher prices will be with us for longer. The other thing, George, that we should talk about is you told me in a prior interview that for your own portfolio, you want to have 80% of your money in things that pay you.
Right.
The beauty about the natural resource business, if you don't chase incredible alpha by taking the risks and the penny dreadfuls, is that these businesses have a reasonably good history over time of generating free cash and sharing it with shareholders. If you were to construct a portfolio today of 10 or 15 large natural resource companies that were paying dividends in excess of 5% from 40% or less of their free cash flow after sustaining capital investments, it would be an easy portfolio to construct. So in that part of, from that portfolio parameter, it makes sense for you too.
Well, let's take it a step further here. So we understand cheap and expensive. We understand that there's some nuance with the oil market, as an example, right now, that might not make the price cheap. It's still expensive, but there's a
Yes.
very strong argument for it to go higher. So if you were a type of investment or investor that had maybe a different framework than I do, then it still could be a good time to buy. How do we layer on the dividends on top of the buy cheap, sell expensive? I mean, let's just say that something is moderately expensive, but they're just paying an incredible dividend and it's extremely strong. And if I look at that from a standpoint of actually buying the entire business, like a McDonald's, in the sense
Yep.
that, okay, even if it is a little expensive, maybe I should buy it because I never want to sell this, assuming that I continue to get paid what they're paying me right now indefinitely into the future.
So when you look at the dividend, you have to look at a sustainable dividend. It needs to be paid out of net free cash flow. That is net of sustaining capital investments. If a company is generating $1 a share in operating margin and they're paying out 80 cents a share in dividend, that's not sustainable because they're not making sustaining capital investments. They're in fact cannibalizing the company. But if the company is paying a decent dividend out of 25% of free cash flow, and historically they've been able to replace the reserves that they've produced with, say, 40% of free cash flow, that's a very sustainable business. If you look at the oil business now, in North America at least, we believe that on a net present value basis, that the companies are discounting $55 or $60 oil. And importantly, they're discounting $3 natural gas prices, prices that are 35% below the peaks, or pardon me, below the prices that we're seeing today. So even though the oil price has to go down, or doesn't have to go down, but even though the oil price can go down because it's more than ample to sustain the industry, the truth is that the equities are still priced to discount much, much, much lower oil prices. So we're in an interesting circumstance. The thing that makes me a little more bullish about oil than I normally would be is simply inflation. That is to say that the costs to maintain a company's production, new project expenditures, as an example, sustaining capital investments, as an example, means that the fully loaded cost to produce a barrel of oil might be $60 today, but my suspicion is that 3 years from now, it'll be $70 or $75 a day. In addition, we're experiencing an increase in social rents worldwide around the resource businesses. There will be more permitting delays. There will be more indirect expenses. Oil companies and mining companies will have to build more schools. They'll have to build more infrastructure. And the consequence of that is that in-place assets, paid-for assets, are going to become more valuable simply because constructing competing assets will become more expensive. And because of that, I believe there's maybe more upside to large producing companies in both mining and in oil and gas than people perceive, because the sunk value of their capital, particularly after depreciation and depletion, I think substantially understates the value of those producing assets.
Rick, another thing that I like to try to incorporate into my investing framework and strategy is not only buy cheap, sell expensive, but buy panic and sell
Yes.
hysteria. And I got that from our good friend Jim Rogers.
Right.
And so on that note, and I was trying to think this through last night. Okay, we go back to oil. We look at, okay, there's probably a lot more tailwind than there is headwind, even though the price itself, historically speaking, is rather high. If you look at a company that's paying a good dividend and that dividend is very solid, another benefit there, or pro, would be that in the future, most likely the cost of getting that oil out of the ground will be more expensive. Therefore, it kind of limits your downside, especially if you're wanting to hold that company over the long term. Is there an argument for looking at a company that's tied to Russia? And what I'm referring to specifically is Luke Oil. And because, okay, let's just say that oil is trading at 90, a little expensive, but if you can buy Luke Oil at a discount, maybe I know it's probably not this extreme, but let's just say that you could buy Luke Oil at where it was trading when oil was $40 a barrel, just because of what's happening with the conflict between Ukraine and Russia. Is that something that in the past you've taken advantage of?
You've put your finger on precisely what I'm doing in my own portfolio. Are there political risks in Russia? Sure. There are political risks in the United States too, and they're understated. I own Gazprom, I own Lukoil, I own Norilsk, I own Polymetal, I own Polyrus. The Russian natural resource companies are, by any reasonable valuation measure, the cheapest on the planet. They have a preponderance of tier one assets, which means not marginal assets, but very, very, very good assets. They have low sustaining capital costs relative to other parts of the world. They have long reserve life indexes relative to other parts of the world. They have high operating margins and high return on capital. And importantly, they're controlled by the oligarchs, which means they have owners. Which means they tend to be shareholder friendly.
Yeah.
You look at a company like Polyrus paying out 40% of free cash flow after sustaining capital investments, fairly heavy sustaining capital investments. What you have is that Polyrus is owned by a couple of people. It's not owned by BlackRock and Vanguard and Fidelity. It's owned by living, breathing human beings who believe that the company's obligations to shareholders is larger than their obligation to the World Economic Forum.
That's right. There you go.
Something that I like.
That's a great point right there.